FICO stock just dropped another 11% in a single day because of just 5 words, and yet I'm calling it a screaming buy. Here's why. Before that, let me tell you what just happened. Shares of Fair Isaac Corporation, the company behind the widely used FICO credit score, plunged this week after Bill Pulte, director of the Federal Housing Finance Agency, took to X and said, still not happy with FICO. Yep, just 5 words. But that tweet sent FICO stock tumbling over 11%, marking its biggest single day drop since March 2020. Over the past 5 trading days, it's now lost over 37% from its recent highs. So let's see what's the issue. Bill Pulte got appointed under Trump, has repeatedly expressed frustration over FICO's pricing strategy, especially their decision to raise the wholesale royalty fee for mortgage scores from $3.50 to $4.95 late last year. That's more than a 40% increase, and it didn't sit well with lawmakers or regulators. Senator Josh Hawley even wrote to the DOJ asking for an antitrust investigation into FICO, calling it the only real competitor in credit scoring and accusing them of making prodigious profits at the expense of working Americans. Now, here's the bombshell. Bill Pulte is pushing for a shift from a try-merge to a buy-merge credit scoring model, and this change could hit FICO's revenue. Let me break that down. When someone applies for a mortgage, lenders typically pull credit reports from all 3 major credit bureaus, Experian, TransUnion, and Equifax. That's called a try-merge report. The idea is to get a full picture of your credit from all sources, and that includes multiple FICO scores. What Pulte and others are proposing is a buy-merge system where lenders would only need to pull reports from 2 of the 3 bureaus instead of all 3. This would reduce costs for lenders and mortgage applicants, but it would also mean less reliance on FICO scores and less revenue for Fair Isaac. This move is being pitched as a cost-saving measure in an already expensive housing market. But for FICO, it's a direct threat to their near monopoly position in mortgage scoring. And here's the kicker. Pulte says the FHFA is looking into this actively and could make a decision within 1 to 3 weeks. That's why the markets freaked out. But not everyone is bearish. In fact, analysts at Jefferies reaffirmed their $2,500 price target and called this the buy the dip moment. They noted FICO's royalty fees make up less than 1% of total mortgage closing costs, and any move to buy merge would likely have minimal earnings impact. Now, here's where it gets interesting. We have already covered FICO in our stock prediction series and projected over 200% upside. Our prediction was based on strong fundamentals, dominant market share, and inelastic pricing power. And honestly, that still holds. Yes, if buy merge becomes the norm, revenues might take a hit and we'll revisit our forecast if that happens. But at this point, it's just regulatory noise, not a change in business fundamentals. So here's what I'm doing right now. I'll be starting a position in FICO very soon. And the reason for that is this is a high quality business under temporary pressure with massive long-term potential. I love buying great stocks when there is noise and fear. And technically, it's approaching a strong support zone around $1,100. That's exactly when you want to be greedy while others are fearful. Let me know your thoughts in the comments. Is this an overreaction? Should FICO be investigated for anti-competitive behavior, or is this just a golden buying opportunity? Drop your thoughts below and don't forget to like, subscribe, and check out our full stock prediction playlist for more deep dives like this. Thanks for watching, and I'll see you in the next video.